Hey, Dan here, stockmarketmentor.com. Happy Friday. I want to look at Kroger today, and here's why. You saw what happened today. Okay, that's obvious. But when I was in my training session on Wednesday, one of our members, a pretty prominent guy in the forum who posts trades every day, and they're pretty damn good, frankly, had asked in that session, hey, what do you think about Kroger? It's popping above the 200-day moving average. Volume looks pretty good. You think it's worth a shot? And I said yes. However, I also said just be mindful that this last high here, it's not too far above where this is now. So this could give it a little bit of trouble. So you got to watch this level. If the stock breaks out above that level, then this could be off to the races. I think that's kind of what I said. But the point was you got to respect this last high, especially in this kind of market where breakouts typically aren't working. There's really not a lot of follow through. It's kind of like they suck you in. And then once you're in, then they snap hook and slam you down like a wakeboarder or body surfer going over the falls at the Wedge here in Newport. It just generally isn't a good result. So I was a little bit concerned about that. And then the next day, so this reversed, right? Still stayed in pattern, still stayed above the 50-day moving average, but it did reverse. And then today was earnings. Boom. Stock gapped up, still below yesterday's open. So this was still kind of right in the range. And then really the time to be buying was right here when the stock popped above 50.14, which was the high. So if we just kind of extend this over, what was the high? A little bit above here. Yeah, 50.34. So another 20 cents above that. It's not that big a deal. It doesn't really matter, 20 cents. But the point is, on Thursday, this came up to that level and then it fell. So the lesson here, boys and girls, is that just because you see a stock that looks like it's going to break out, you have to look at the entire pattern. Because just because you see then the next day, oh crap, it didn't break out, don't ignore it. Don't give up on it. It did this for a reason. And then whatever this was, that was for a reason too. But the pattern still holds, so you got to watch the stock. If you're not willing to watch stocks that are setting up, then you're just going to wind up day trading. And you're always going to be reacting to something. So you don't really want to be doing that. All right. And so what we did today, I talked about putting this on our active trade list, but I couldn't do it. I couldn't pull the trigger because it was up so much by the time I saw it. I have a small position in the stock. I took it right around here, around 51. So I'm not real profitable on it, but this is my plan. My plan is that, of course, if the stock continues to run, that's a good thing. I'm glad I have some, but it's not really enough to, make my day. It's just a small starter position. But if the stock pulls back closer to here and then holds, then I'll add to it and make it more of a meaningful position under the same rationale as I just gave you. The stock's doing this for a reason. And it's institutional buying. Over 10 million shares traded. That's not you and me slinging our little accounts around. And so when institutions make a move like this, they're not day trading. They're not just going to say, oh, crap, we made a mistake. We didn't mean to buy this, and then sell it. They're starting a campaign. They're starting to buy this stock. If it goes up too much, then they're not going to bid against themselves, so they'll back off, and the stock will back off, and then they'll be back again. At least that's my thesis. So as long as the stock stays above this 200-day moving average here, as long as it's doing that, then I'm going to be comfortably long, as opposed to Pink Floyd's comfortably numb. As long as it stays above here, I think it's all good. So anyway, that's all I got for you. I hope you all have a good weekend. We'll get back to it on Monday.